This is the Brothers on Books podcast, the greatest podcast with the best brothers talking about the best books. Please welcome your hosts, Jack and Alex, the Brothers on Books.
What it do? This is the Brothers on Books podcast, where we find great books that will give you real value and actionable steps and have fun in the process. Please reach out to us at brothersonbooks@gmail.com for any book recommendations, or if you would like to be a guest host for a particular book you have in mind. A great review or rating on whichever platform you're listening to this would be greatly appreciated. And lastly, if you can think of any friend, family member, or coworker that might like this episode, please pass it along. I am Jack Allweil, and with me, as always, is my brother, Alex Allweil. Al, how are you doing today?
I'm doing well. How are you?
Doing great. It took us this is our 25th episode, and we are finally in the same location.
Yeah, finally recording, I guess, truly together and not just together over Zoom.
Yeah, we are coming from Myrtle Beach, and today we have a doozy. We are discussing WallStreetBets, how boomers made the world's biggest casino for millennials. Al, what did you think of this book?
It was it was very, very entertaining. Thought it was an easy read. I would start with. I feel like I actually learned a lot. There were investment terminology that I wasn't super familiar with, and I enjoyed it. Some of the stories were hilarious. What did you think?
So Jaime Rogozinski is the guy who actually started WallStreetBets, the subreddit on Reddit. And when I first started reading it, I kind of thought he was just looking for some quick cash to profit off of his subreddit. But the more I read, the more entertaining it became. I thought it was quite well written, and he painted a good picture of the environment that a lot of these millennials are operating in and kind of their thought processes. And I also enjoyed the stories a lot. So with that, before we get into some of the stories, you want to go to the pickleball ad?
Pickleball, the greatest sport you've never heard of. Pickleball is the fastest growing leisure sport in the United States. It is a mix between tennis and table tennis. However, don't let the average age of participant in this sport fool you. The game has fierce competition, and only the will of a champion can thrive. Go buy some paddles and balls and play pickleball. The greatest sport you've never heard of. Hopefully, while we're here in Myrtle Beach, we'll be able to play some. I was reaching out to some randos to try and get some games set up. None of that has really panned out, though.
One important thing, he kind of went through how investing in stocks used to be versus now, and some of the things that a lot of the common people didn't have access to, and we still don't have access to everything. He kind of talked about how a lot of pro investors, if they want to, I guess, invest in leveraged products, a lot of them invest in futures, and that's not even, we don't really have access to that. But one thing a lot of people have access to are options. And walk through how back in the day, the commissions alone used to be a lot. And, if you had $1,000, you might be paying $30 on the buy, $30 on the sell. And, that eats into any profits you might have had. And now with the emergence of Robinhood and a lot of other brokers following, you can trade oftentimes at zero commissions. So that's kind of cool. Well, what did you think of? He kind of painted the picture of like investing is kind of like just a casino for the elites, and it's kind of like a club that not everyone gets to go to.
It was almost sort of, I guess, the difference between the layperson who, I don't know, is always just sort of told to, you have a 401k if you're an employee and you have a match. You're just sort of told to invest money into your 401k and put money into the stock market and grow it at I guess the deemed value is like 8% over your life. So you have a retirement egg. But then what he's saying some of these like Wall Street people are doing is just these highly leveraged things that go over a lot of which go over my head, which seem to be very, very risky, where huge upside and you have these huge swings of wealth where you're gaining a lot of money and also losing a lot of money. I guess the normal person is not doing that, right?
Yeah, it sounded like he started WallStreetBets. So a lot of people talk about investing for the long term, but in terms of making like short-term investments, it sounded like he made this really to discuss, to create a forum to discuss short-term, for lack of a better phrase, YOLO picks. If you have like an earnings call coming up and people can discuss placing bets to basically, you might lose everything, but you might make a whole lot. And it sounds like, and I've looked a little bit on the forum, and that there is some good like educational material and people can discuss their bets and the picks.
He also does elaborate that there's a Reddit investing subreddit, which is used for the historical perceived investing tactics, where you're just putting it into very safe returning assets that can grow at a normal rate over time.
Yeah, and then he goes into different leverage like ETFs and ways that people on WallStreetBets have looked into more ways to get or amplify their returns in a short period. There were a couple like social issues he kind of brought up that I thought were interesting. Like, for example, like a pattern day trader. So I actually didn't know the definition, but I've kind of, sometimes when I trade a lot, I do get the notification, like if you do more than, I think it's buy and sell 4 times in a 5 business day window, you're considered a pattern day trader. And if you're classified as a pattern day trader, you need to have $25,000 in your account. And that whole, he did bring it up, and there's people that have complained about this, because why can't a person with only like $10,000 day trade? It's kind of like cutting them out of the system. And is that really just?
Yeah, does he elaborate as to why that law is in place?
I mean, the thought is that if you're trading on like margin, they kind of classify you. You need to be able to show you have enough, I guess, to offset some of the risk you're taking. And they've somehow come on $25,000 as doing that. It kind of begs the question though, like maybe it would be better, instead of just having a dollar amount, to maybe require people to take an exam or something to show that they kind of understand some of these trades that they're making. And I mean, he has one funny story of this guy that bought calls. I think it was on Disney or something.
Disney, yes.
Yeah. So he bought calls on Disney, and a call is basically the option to buy a stock at a certain price on a certain date. And this guy got assigned the 100 shares for the contracts, it was more. I think it was 100 contracts. So this guy got assigned like a lot of shares, and he did not have the money to cover that. But so the broker lent him the funds to buy that. And if the stock would have then gone down, he could have lost a lot of money. But the stock ended up going up, and he ended up being up like $100,000. And he was totally surprised. And he posted this on WallStreetBets, and people like, I guess it's education for the rest of the people. And he had a fun time with this $100,000. I think they charged him $9,000 in interest holding that cash that he was lent by the broker.
Right. So that brings up, if they loan him the money and then it goes down and he then loses, so he would then potentially lose a fortune. Yeah. Does he then, how does the broker go after him if he can't pay that back? I mean,
I actually don't know how that works. Yeah, it's interesting, because he talks a lot about how like people are trying to cheat the system kind of, and trying to get their cash out and still have the upside.
It seemed like there were a lot of instances where people were taking, it's not their fault for the broker's inefficiencies, but taking advantage of the broker not being totally aware of things and essentially giving them free money to use.
Yeah, there was an example of this guy that was selling covered calls, So he bought stocks and then he sold calls on these stocks. So he was getting premium from selling these options. And because he had a margin account, it then, so like if he collected 200 in premium, it was showing it basically let him use that money to go buy more stuff. And since it was margin, he, instead of only being able to buy like 200, he could buy like 400. So then he would buy more shares and then sell more options. And then he'd be able to, and it would just go in a cycle. And I think the guy got up, like his original 2000, he had like $50,000 in purchasing power or something, which is crazy.
Going back, do you want to sort of explain what leverage is a little bit, maybe?
So you can think of it as basically just you basically control more items. So like on your house, like if you were buying a house, when you put 3.5% down on an FHA loan, you kind of control that whole house. So it's kind of the same idea. So like you only have to put 3.5%, but you're controlling 100% of the house. Whereas like in stocks, like you might have to put up half the money. Let's say you have $100, you basically control $200 worth of stock oftentimes. And some of these option prices, each contract is 100 shares per contract. So if you have, I don't know, let's say, I don't know what Apple's at, but let's just say it's like at $100, you can buy these, what they call out of the money calls, let's say for $110 in a month. So if Apple goes above $110 in a month, that option is basically worth whatever the price is minus 110. But that's for one share. And then you like basically multiply it by 100 is what you would get. So, and you can buy these options for a fraction of what it would cost to buy 100 shares of Apple. So you're kind of levered up. So let's say Apple got up to, on that 110 call example, if it got up to 120, so maybe you bought each one for like a penny. So maybe you spent $1 getting the rights to that, and at 120, well, now that each one's worth $10, so is that like $1,000? So and then for each dollar it goes up above that, I mean you're making $100 per. Yeah, it's just like having access or control over more shares.
So he makes the point of, if you're using leverage, if you want to day trade, if you want to just day trade and you don't have a lot of money, you essentially have to use leverage. I think he makes the point that if you want to live off of like $5,000 a month, right, and you have $100,000 in capital and you're just going to buy or sell stocks, every month you would have to make 5% to live off of, well, actually more than that, right? Because minus your taxes, you would have to make 5% plus your taxes, live off $5,000 a month, not using leverage.
Yeah, I mean, it would be hard to. Oh, so you're saying, if you had $100,000 and you wanted the chance to
just day trade without using leverage, if you're just gonna traditionally buy, and sell stocks, you'd have to make 5% on each month.
Yeah, that's crazy. That's a really high return. Like
that's. But if you were using leverage to make $5,000, you could.
You might be able to, but it's also risky in the sense that you could lose everything.
Right. When he's talking about these, these 3-to-1, like these 3 times like ETFs, I guess just intuitively, and this is sort of what you talk about, margin calls. Like when it goes up, if you have a 3-to-1 ETF on gold, so the price of gold goes up like $1, your ETF should then go up $3, correct?
That's theoretically how it's supposed to work. He kind of goes through and talks about the further removed from like the underlying asset you are, the more, if there's more disconnect, the more it can go wrong. And he talked about a couple crashes where like maybe if you had like an ETF of a bunch of stocks, like the ETF doesn't reflect what it should be holding, or if there's some disconnect like in your 3 times example where it's not mimicking the underlying exactly. And it sounds like there could be all sorts of reasons, because I think the way it sounds like they create those 3 times levered like ETFs is that they're like buying and selling futures. And there could be something that happens in one of those steps that becomes disconnected from the underlying. And a lot of people can take advantage of this. And he kind of he talks about how people have become good at finding the cracks in the system and exploiting them when they can. And kind of, he also talks about like how our generation's good at like finding cheat codes, like just like video games and finding ways around the system.
Yeah, it seemed like a lot of the stories he highlighted were people that either sort of like what you were talking about with selling the calls, right, where he was just getting the premiums put back so he could use again. It seemed like it was a lot of stories of people getting free money from their broker to then reinvest to sort of set up these like almost infinite cycles.
Yeah,
which were quite entertaining.
Well, one other thing that's interesting about Wall Street Bets is like oftentimes you only hear about people when they make money, and Wall Street Bets kind of has a culture of like these YOLO plays, and people will screenshot like, yeah, I lost like 140 grand today, and like I've lost everything, like, and then people will say like, dude, legend.
Yeah, it's like they're glorifying them doing these things. And it's just bizarre to me.
He actually brought up the point. It was kind of similar to how, not terror, but like, yeah, like terrorists or shooters kind of are glorified, and that this kind of culture could be toxic in the sense that maybe other people think, yeah, I should YOLO too, and I could become famous on, Wall Street Bets. Because some of the numbers are staggering. Like people will go from like 50 grand to like $750,000 and then YOLO it, like when they really could have just changed their life if they just would have
gotten out.
Gotten out.
It almost did seem like, reading some of these stories, it almost did seem like a gambling addiction. Like,
yeah.
Or, they think, they do these incredibly risky bets and they keep winning, and then they just sort of, think they're like God and they can't go wrong and lose it all. And that's got to be the most depressing. After making all that money, then losing it all, it's got to be the worst.
You did talk about a couple of stories where the people did have the sense to get out. Like there were some crazy call. Like this kid bought calls. Like I think the stock would have had to have moved 20% the next day. Like they were options that expired the next day, and they were 20% higher than what the stock price is currently at. So it would have had to gone up 20% just to break even, basically. And this kid, I think he got out and bought some rental property, like 50 grand or something.
I think it was more than that.
More.
I think he likened it to buying hurricane insurance. That trade, I think, is the one that he made the analogy to buying hurricane insurance in like Colorado. Where apparently, like, there was some very, very strong weather in Colorado where if you had the insurance, you made out. But it's like so cheap because it's so rare. There's like almost no point in not buying it.
Yeah.
I got the feeling like a lot of these kids kind of took like we talked about Black Swan. Like, they just look for these Black Swan events, but they then, in my opinion, at least from what we're being shown, is they're too concentrated, is they're just going everything into a single potential Black Swan event. And then you only really hear about the ones that either make it and make a ton or just lose everything. But I think the underlying principle was that you want to be exposed to a multitude of many different possible Black Swan events.
Yeah.
So I guess the right idea, the wrong execution, maybe.
Yeah, it's hard to. And plus, where's a 19-year-old getting like 40 grand? Like they were talking about some of these kids. Like, I just don't know. I mean, it strikes me as that they're probably not making that money themselves, because if they had thought about how long it took them to make that, or does it underline the feeling that they think they have to bet it all just to have a chance? I don't really know. Kind of weird.
I mean, even like I'm talking about 19-year-olds with like 10 grand.
Yeah.
I definitely did not have 10 grand to just play around with when I was 19.
I mean, we do have, and we had Jason Brown on last week or 2 weeks ago, talking about the, $1.7 trillion of student loan debt. It sounds like a lot of these kids oftentimes do have student loan debt. So I wonder how much that plays into their thinking they need to YOLO to get out of it.
or you can just get the loans for being in college to try and make it all back.
Oh, I didn't even think about that. Maybe they're using their student loans to YOLO.
I think at one point someone said that they took a loan out that they were going to have for like 6 months, and he wanted a super safe investment to put it in to just try and mitigate some of the percentage costs that he was going to be paying. So maybe some of them, that sounds incredibly risky to me, but maybe there are some people that are doing that. You want to go over maybe one of your favorite stories from the book?
Well, I like the story of the guy that got assigned the money, and he woke up the day later and sold. And luckily he looked to check on his stock account because he saw that he got assigned those shares, and he was able to sell. And luckily it went up. I mean, that was kind of a funny story and something to learn from, because that could have been disastrous. And I mean, I love the story of, I forgot what, but basically this guy was participating in what's called a box spread, and he kind of thought it was riskless, and on paper it kind of seemed that way, but soon enough he what was he down, like 60 grand?
You owed the brokerage account 60 grand.
60 grand.
Do you want to explain? But the funny thing was that he got out of the account up 100% on his initial investment, and then I think it was Robinhood, closed his account out and then said that he owed them 60 grand. So who knows if he actually paid him or not. But he got all of his money out.
Really?
Okay, so he ended up, but his account had a negative balance when they closed it. So who knows if they would have came after and sued him or not. I would assume that they did.
The other really cool story was that kid that was living in his parents' basement, and he found a way to, I guess, trick the system into thinking there were buyers. He was like simulating buyers, but there weren't actually buyers.
Yeah, I didn't really understand that.
And then I guess he made like millions of dollars, I think. He was like a teenager, and he basically thought he was playing a video game.
Page 96, this guy that was trading the XIV, not the VIX, when the XIV collapsed, and he went from like 4.3 million, lost the majority of that 4.3 million in a single day. And they have the ticker tape for this XIV, and it literally is just going up over years. And then on a single day, it nosedives from about $110 to $10. This was kind of one of the times where he demonstrates how the underlying can, that there can be a mismatch between what you think you're investing in and the actual underlying product. Because I think there's like a couple layers of derivatives layered over. Yeah, I did this. Right.
Yeah.
He posts out this flow chart of how this derivative for this XIV or VIX worked, where it was stocks in the S&P, then your options, and then the VIX index, VIX futures, and then VIX ETF. But yeah, it's just sort of sad because it sounded like the guy that was trading it was very good, and he had turned $50,000 into $4 million in 3 years, which is phenomenal. And that was the guy that ended up losing a lot. Yeah, he then lost essentially everything that he had made in those 3 years in a single day. I think his story became famous though, and I think he got a job after all that. I can't quite remember. Because I think he was pretty public about sharing what had happened to him. Right. Some interesting stuff. But then there was a hilarious. Then people bought to sue. So Credit Suisse was the issuer of this ETF, and they liquidated it a few weeks later. And they're saying that in this span of like a couple of weeks, investors lost an estimated total of $1.6 billion. Wow. They then tried suing Credit Suisse to no avail, thanks to a surprisingly accurate description of the product on page 197 of its prospectus. The long-term expected value of your ETNs is zero. This is 100% serious. If you hold your ETNs as a long-term investment, it is likely you will lose all or a substantial portion of your investment. And that was in their own perspective of this derivative.
So I guess that at least shows they understood what could happen.
Selling, right?
Yeah. So someone was smart enough to put that, and that kind of saved them from getting sued, right? So yeah, because it says the disclosure form was hundreds of pages.
Right, but seriously, seriously, who reads that?
Right. But that I guess it goes to the point that you kind of need to understand how whatever you're buying derives its value. How is it created? And there's risk to some of these derivatives that might not be totally matched up with what they're supposed to represent. Like you could have, a 2 times gold fund that might not always be 2 times, and even though it's supposed to be, or whatever the underlying is versus what you're putting your money in. Probably should,
So I guess I was always confused. So like just the 1-to-1 gold and silver funds, which I own, so GLD and SLV. SLV is pretty consistent, at least close to the spot price of silver. But the GLD one, when the spot price of gold is like around $1,800 or $1,900, but GLD is around like 170. So like I was always confused as to why.
Does it at least like if like actual gold goes up 1%, does GLD normally go up about 1%?
It normally mirrors it, right?
Okay.
So is it just? I'm assuming they maybe just dilute the price down.
Yeah.
So it's more
available. Yeah. Because I think right now, one of the things Peter Schiff has been saying is I think that Bitcoin Trust is supposed to mimic what Bitcoin's doing, but you can actually buy the trust at like 15% discount. Yeah. So it seems like the trust, I don't really know what that trust is, but I keep hearing that. So
I think, because when he said that, I remember thinking I'm just going to go buy it. But then it sounded like you had to hold your money in there. I was a little confused.
I'm not quite sure. And I think there's a Bitcoin ETF now, BITO. And I don't really know what the difference between like that trust and the BITO are. So,
yeah, I don't really understand why, especially if the trust is just Bitcoin, why you would buy the trust instead of just buy the Bitcoin yourself.
Right, but I guess if the trust is supposed to mimic what Bitcoin's doing, and you could get a discount on the Bitcoin.
Oh, right, yeah, you can get a discount. Right?
Yeah, and that's kind of what he's been saying. So it's just sometimes, it doesn't always move the way you think it should move. That makes it more fun, I suppose.
In his words, you're gonna sell $1 for 90 cents. Obviously, a lot of people are gonna buy $1.
Yeah.
With the hopes of then selling said dollar for $1.05.
Yeah.
A lot of people then probably won't buy it. I'm sort of paraphrasing, but it's general.
So what was your favorite story?
The box spread one. Spread. Yeah. Maybe do you want to explain what box spreads are?
It's kind of complicated if you can't draw it out, but you're basically doing a call spread would be buying a call and then selling a call at a higher strike. And then with those same strike prices, buying a put and selling a put. So you're buying a put, selling a put, and then buying a call, selling a call. And if you draw out like the profit diagram, I think what he was showing was he basically it's a straight line. It ends up being a straight horizontal line, and he was going to get a little bit of cash. But the thing he didn't think about is if, I guess, he got assigned some of those shares before it expired. And you can just Google box spread if you're interested.
But you're essentially looking to profit from a discrepancy
like,
in buying and the selling of the spreads.
It's like an arbitrage kind of deal.
I mean, this other little anecdote he has in there of just sort of something stupid to show maybe that really no one knows what they're doing, but catchy tickers beat the market. And he has this image up where firms with clever ticker names up over like 200% from the market, showing that people are maybe just buying fun ticker names. And
he had some funny ETFs he brought up, like PBJ is like food and beverage. I think Cure was like for if you're bullish on healthcare, and SICK was if you're bearish on healthcare. But yeah, that study I think was like by Pomona, or I don't remember. But yeah, I don't know how they define clever also, but there's some funny names. And I think the idea with a lot of this community on WallStreetBets is they kind of like, they rally around these like fun names. And then they just like try to create a force to like pump and it kind of, I mean, GameStop, you kind of had that when.
A lot of them, AMC too.
Yeah, AMC.
BlackBerry.
So,
I mean, I don't like to throw AMC in the same category as like BlackBerry and GameStop because I frequent AMC quite a bit. And I don't know anyone that still uses a BlackBerry. I didn't realize that was still a company.
I guess the interesting thing is I actually thought I think this book actually came out before the craziness in GameStop. Oh wait, maybe not. Well, I think he said on a podcast I heard that he started writing in 2019, but this says 2020, so I don't know. Yeah, I enjoyed this book. Kind of very, very entertaining.
Do you have a favorite quote?
I don't think I really had a favorite quote, but I think my main takeaway was maybe try to understand more how some of these derivatives derive their value off the underlying assets they're supposed to represent, not to be too concentrated.
Yeah, I feel like I need to read more and just spend more time actually trading options to truly get a feel for what I'm doing. I don't really still feel, even though I've read a couple books now. I've read parts of a couple books and listened to a lot of videos on it, but I still feel like a little lost, and I just would like to read some more and start hashing it out myself.
It's a good thing you picked the dynamic hedging,
right? And
that was one of our future books.
That was part of the reason I did that.
Yeah, and we should be getting Mark from Options Bootcamp to discuss that with us, so that should be fun. That is a very large book.
Yeah, that one may
it's like a math textbook, but
different from most of Taleb's normal writing.
Yeah. So we were kind of just, do you any other?
I was just gonna say I found this top comment in a brief history of YOLOs. I found this top comment hilarious on Nilson Bunker Hunt, an oil man who attempted to corner the world silver market in the 70s, ended up holding a third of the global supply, caused silver to go up from $11 an ounce to over 50, and profited close to $4 billion. And then there's some flowery language, but got slapped in the face by the government, lost it all, his edge, massive balls. Then just sort of the key underlying quote was, to be successful, you must decide exactly what you want to accomplish, and then resolve to pay the price to get it. I thought that was sort of a funny anecdote.
Very cool.
I think he also did that with his brother. I think it was actually, I thought from my heard the story, was the Hunt brothers who did this and then lost all of their money, which is impressive to lose over $4 billion in the 70s.
What type of metal could we corner?
A rare one.
But we could have it all. It would have to be really rare.
If you had some of those, probably if we had, I don't know if your wife has a Russian passport, but if you could get into Russia, your best chance is probably cornering some of those meteorite metals like iridium or rhodium iridium or rhodium. They're usually only found in meteorites. That I think it's still that one meteorite that hit in Russia like 5 or 6 years ago is where the main supply of those come from.
Okay, well, we'll put that on the to-do list. So we were kind of discussing that in hopes of getting those tendies and whatnot, that we thought it would be fun to have like some sort of YOLO segment. And did we decide on an amount? Well, we're going to basically set an amount and then come up with bets that fall within that budget. And obviously we're not telling you to do any of this, but this is what we will be YOLOing with. And
I think the amount 250 max.
250? Okay.
I don't think that it doesn't have to be a single bet.
It doesn't have to be one. And do we have a time frame of which we'll reassess the winner?
I think we should. I think we should talk about it at our next recording.
Okay. So, we'll have the bets for the next recording or no?
Have made the bets?
Yeah.
Yeah, I think we should have made them.
Okay.
The next recording.
But I guess, do we need it to stay like within the next 6 months, or like if we were to do options?
Oh, okay. Yeah, I think you can have them expire whenever. Well, I don't know. We're making the rules right now. What do you?
I say let's do the next 2 months. It can be it could be sports betting, it can be options, it can be stocks, whatever.
Okay.
So we're starting. Each of us will start with 250, and the bet must be done in the next 2 months. And
okay. So is the winner just who then converts the 250 into the most money?
Yeah.
Okay. I have a feeling that I'll probably be at zero, but
it's okay. It's okay. There's no you might as well risk it for the biscuit on this one.
That's right. Yeah.
And we'll post these on the website,
yeah,
I guess,
yeah.
Of what our picks are. And so you got any closing remarks?
I think I'm gonna do at least one like 10-team football parlay.
Okay. NFL, you mean?
Yeah.
Yeah. Okay.
That's just my initial thought.
That should be fun. I might go deep into the Turkish soccer league or something.
I think you have a distinct advantage of me over the options.
I don't know. For just for a YOLO play, I don't know. We'll see. So should we close it out?
Yeah, I think so. It's been a good episode. It was a fun book.
Yeah. So please reach out to us at brothersonbooks@gmail.com for any book recommendations, or if you would like to be a guest host for a particular book you have in mind. A great review or rating on whichever platform you're listening to this would be greatly appreciated. And lastly, if you can think of any friend, family member, or coworker that might like this episode, please pass it along. And Al, what are we reading next time?
The next book we are reading is called On Grand Strategy. You could say it's a departure from the normal type of book that we have been reading.
Okay. That's cool.
It's been enjoyable so far. I'm about 70 pages into it.
Awesome.
Yeah.